In 1989, the land beneath a single royal garden in central Tokyo was, on paper, worth more than every acre of California. Not more than California's farmland, not more than its commercial real estate, more than the entire state. How does a country build a bubble that large? And why, once it burst, did the damage last not 1 decade but 3? The answer is more surprising than it sounds. And there is a single document signed in a hotel suite in New York in September 1985 that started the mechanism. We will get to that document in about 9 minutes. And once you understand what it committed Japan to, the Imperial Palace figure stops looking like an absurdity and starts looking like arithmetic. To understand the bubble, you have to start with the decade before it. Japan in the 1970s and early 1980s was not a country in distress. It was a country that had engineered one of the most sustained industrial expansions in recorded economic history. Between 1960 and 1985, Japan's real GDP roughly quintupled. Its trade surplus with the United States widened every year. Its manufacturers, in steel, in shipbuilding, in consumer electronics, in automobiles, were systematically displacing American competitors in their own domestic market. By 1985, Japan held the largest bilateral trade surplus with the United States of any country on Earth. Washington was losing patience. The Reagan administration, facing a soaring dollar and a widening current account deficit, wanted the exchange rate corrected. What it wanted, specifically, was a cheaper dollar against the yen. The mechanism for that correction was negotiated quietly over 2 days in September 1985. The venue was the Plaza Hotel on Fifth Avenue. The 5 finance ministers and central bank governors who signed the resulting agreement from the United States, Japan, West Germany, France, and the United Kingdom called it the Plaza Accord. Its stated purpose was orderly exchange rate adjustment. Its effect on Japan was something else entirely. The Plaza Accord was, at its core, a coordinated agreement to talk the dollar down. The signatory governments would intervene in currency markets and issue public statements designed to shift trader expectations. It worked with unusual speed. In September 1985, $1 US bought roughly 240 yen. By the end of 1986, it bought fewer than 160. By 1988, it was approaching 120. In under 3 years, the yen had appreciated by roughly 50% against the dollar. For a country whose economy ran on exports, this was an existential shock. A Toyota that cost $100 to manufacture and sold for $150 in the American market was now, in yen terms, earning sharply less on every unit. The export machine that had built post-war Japan was suddenly stalling. The Japanese government and the Bank of Japan faced a straightforward diagnosis. The economy needed domestic demand to replace the export growth it was losing. The prescription they chose was cheap money. Between January 1986 and February 1987, the Bank of Japan cut its discount rate 5 times. The official discount rate fell from 5% to 2.5%, its lowest level since the Second World War. Haruhiko Miyano, who would later become Bank of Japan governor and would attempt to unwind what this created, was not yet in that chair. The chair, in 1987, was occupied by Satoshi Sumita, and the Ministry of Finance under Finance Minister Kiichi Miyazawa was pressing for accommodation. The rate stayed at 2.5% for 27 months. That, in the context of what followed, was 27 months too long. Cheap money alone does not build a bubble of this scale. For that, you need a system for directing the money, for ensuring that the liquidity flooding into the banking system actually flows toward assets capable of inflating. Japan had such a system. It was called Madoguchi shido, which translates, with reasonable accuracy, as window guidance. The Bank of Japan had practiced it since the high-growth years of the 1950s. Under window guidance, the central bank did not merely set interest rates. It met quarterly with the major city banks and told them, explicitly, how much their loan portfolios should grow. Not a ceiling, a target. Banks were expected to hit it. In the growth years, this had channeled credit toward industry, toward the steel mills and shipyards and auto plants that built the export economy. By the mid-1980s, with industrial capacity already built out and export demand suppressed by the strong yen, the credit had to go somewhere else. It went into real estate and equities. The mechanism was specific. Japanese banks accepted land as collateral for loans, and they valued that collateral at current market prices. As land prices rose, the collateral base expanded, which allowed more loans, which financed more land purchases, which pushed prices higher still. Researchers Mikuni and Murphy, writing in their 2002 analysis of Japan's financial structure, described this as a closed circuit. Banks, land, and credit feeding each other with no external check on the cycle. Between 1985 and 1990, commercial land prices in Tokyo's 6 central wards rose by roughly 300%. Residential land prices across the 3 major metropolitan areas roughly doubled. This was not gradual, this was vertical. What was happening in the land market was mirrored, and in some respects amplified, in equities. The Nikkei 225 stood at roughly 10,000 in January 1985. By the last trading day of December 1989, it closed at 38,915. The index had nearly quadrupled in 5 years. At its peak, the Tokyo Stock Exchange accounted for roughly 45% of global equity market capitalization by value, larger than the New York Stock Exchange, larger than London and Frankfurt combined. Price-to-earnings ratios across the Nikkei had reached 60, 70, 80 times earnings. Levels that implied growth trajectories no economy has ever sustained. The standard valuation frameworks used in New York and London had simply stopped applying or had been set aside. There is a structural reason this could happen, and it runs through a peculiarly Japanese corporate arrangement called Keiretsu. Japanese corporations held large cross-stakes in each other's equity. Banks held shares in manufacturers, manufacturers held shares in their suppliers, insurance companies held shares in banks. These cross-holdings were long-term, relationship-based, and largely immovable. When the float available for active trading is small relative to total market cap, and when the buyers in that float are running on cheap credit and window-guided loan growth, prices can detach from fundamentals with unusual speed. This channel covers the machinery that makes financial history, the kind of institutional plumbing that rarely makes the headline but explains everything underneath it. If that's a register that interests you, it lives here. The figure that became the shorthand for the entire era was this. At the peak valuations of 1989, the 335 hectares of Imperial Palace grounds in central Tokyo were assessed using the surrounding commercial land prices as a benchmark at a value exceeding the assessed value of all real property in the state of California. The economist David Asher cited the comparison in his 1996 analysis. It was later amplified by Richard Koo of the Nomura Research Institute, who used it as an anchoring figure in his work on balance sheet recessions. The number is, in a strict sense, theoretical. The Imperial Palace grounds were not for sale. No transaction could validate the figure. But that is precisely the point. Land valuation in Tokyo by 1989 had become a system of circular self-reference. The price of land was the price at which the surrounding land had most recently changed hands, and the transactions were being financed by loans collateralized against land already in the same spiral. California, in 1989, had a GDP of roughly $900 billion and a land area of more than 400,000 square kilometers. The Imperial Palace grounds occupy less than 1 square kilometer. The ratio is not a curiosity. It is a measurement of how far the machinery had run from its foundations. Up to this point, every standard account of the Japanese bubble agrees on the mechanism. What the accounts diverge on sharply is why the Bank of Japan waited as long as it did to act, and whether once it did act, the response it chose was the right one or the wrong one for reasons that were entirely predictable in advance. Here is the Plaza Accord. This is the document I mentioned at the start. The accord itself, signed on September 22, 1985, ran to only a few pages. Its operative language committed the signatories to exchange rate intervention and to domestic policy adjustments consistent with reducing external imbalances. For Japan, that phrase was load-bearing. It was read and enforced diplomatically as a commitment to stimulate domestic demand, which meant the Bank of Japan's rate cuts were not purely a domestic monetary decision. They were, in part, an international diplomatic obligation. Yasushi Mieno, who became Bank of Japan governor in December 1989, the same month the Nikkei peaked, understood this. When he moved to tighten, he moved hard. The discount rate was raised 5 times between May 1989 and August 1990, going from 2.5% to 6%. Simultaneously, the Ministry of Finance imposed direct controls on real estate lending, a cap on the total growth of property loans as a share of total loan portfolios. The Nikkei fell 40% in 1990. By 1992, it had lost 60% of its peak value. Land prices in the major metropolitan areas began falling, and unlike equity prices, did not stop. Tokyo commercial land prices fell for 15 consecutive years after the 1991 peak. What happened next is where the historical debate concentrates. The standard monetary toolkit, rate cuts, liquidity provision, does not work efficiently in what Richard Koo named a balance sheet recession. When companies and banks are carrying assets that have fallen below the value of the liabilities used to purchase them, they do not borrow more when rates fall. They repay debt. Every yen of income goes to reducing the balance sheet, not to investment or consumption. Aggregate demand collapses regardless of the rate environment. The Bank of Japan eventually cut rates to effectively zero. It did not restore growth. Japan's nominal GDP in 2003 was, by some measures, lower than it had been in 1993. The lost decade had become, by then, a working description of 15 years and counting. What the Japanese bubble settled in the historical record is several things at once. First, it established the outer limit of what window guidance, a system of administrative credit direction inherited from the post-war miracle years, would do when turned loose in an environment of low rates and rising collateral. The system worked efficiently in the direction of capital toward industrial growth. Applied to an asset cycle, it amplified the cycle beyond what a purely price-guided credit market might have produced. Second, it demonstrated at scale that the monetary transmission mechanism breaks down under specific balance sheet conditions. This was not universally accepted in 1991 or even in 2001. By 2008, central bank economists worldwide were citing Koo's balance sheet framework as a foundational reference, in part because the Japanese case had provided 2 decades of evidence. Third, and most contested, the Plaza Accord's role. The Japanese government, then and since, has generally resisted framing the bubble as an externally imposed condition. The rate cuts were sovereign choices. Window guidance was a domestic policy. But the diplomatic pressure to maintain loose monetary conditions through 1987 and into 1988, to honor Japan's international commitments on domestic demand, created a constraint on the Bank of Japan's timing that is difficult to excise from the causal chain. Whether that makes the accord a cause or merely an aggravating condition is a question that Reinhardt and Rogoff, in their 2009 survey, declined to resolve definitively, and the academic record has not resolved it since. The Imperial Palace valuation was never tested. The land was never sold. The number exists only in the model. But the model was the point, a valuation system that had become self-referential, disconnected from any external anchor, producing figures that would have been recognized as impossible if anyone had been required to actually pay them. When the anchor was finally restored, in the form of a lending cap and 5 rate rises, the model did not correct gently. It unwound the way all such structures unwind, faster than it built, and in a direction that nobody who had profited from the ascent was prepared to absorb. If this got you, the next episode on this channel is about the moment a single British merchant bank, built over 2 centuries, was brought down in 72 hours by a trader in Singapore.